The stock market in the last 12 months or so has nearly doubled to more than 80,000 points. It has been driven by the emergence of macroeconomic stability, more calm on politics compared to the last few years, and the advent of monetary easing. And if Pakistan is able to navigate the risks well, is able to preserve macroeconomic stability and enter into an IMF program in a timely manner, then monetary easing should pave the way for further re-rating across the next 6 months. 2023 calendar year, the stock market rose up by about 60%. And so far in 2024, the KSE 100 is up about 25%. And if you look at, the trough levels, roughly the same point last year, this is when we were at the verge of default, and right before we secured the 9-month IMF SBA, the index was trading at about the 40,000 points level. So since then, if you look at the 40,000 points mark, if you anchor yourself against that, the index and the market has roughly doubled from there. So it has been a blistering rally, and it has been a world-beating rally. Several reasons come into play. Initially, of course, like I mentioned, we were at the verge of default. We were able to avoid that. So there was a little bit of a relief rally that we saw come through in the second half of 2023. That morphed into a politics-driven rally because we saw elections happening in February of 2024. So the emergence of relative calm on politics also helped to smooth investor sentiment. And what we're seeing right now as we speak is the advent of monetary easing. We've seen interest rates come down in June, and the expectation is that monetary easing, or the pace with which interest rates will reduce in the next 6 months, which will be much swifter compared to the 150 basis point rate cut that we saw in June. So there is a consensus developing that we will see interest rates come down by another 4 to 5%, if not more, in the second half of 2024. And for the stock market, that is hugely important because it increases the attractiveness of equities as an asset class compared to the other major asset class in Pakistan, for instance, fixed income securities. So as interest rates come down, it is expected that more and more funds will flow towards equities and drive the market higher. Of course, the market does not wait for these events to unfold. It anticipates that interest rates will come down swiftly in the second half of the year. And that's exactly what it's responding to right now. So these are the three main reasons underpinning the swift rally that we've seen since last year. And the next leg of the rally we expect will be driven by this monetary easing that is currently underway. The performance is very much maintainable because let's not forget that interest rates in Pakistan are still near all-time highs. We've never seen interest rates in Pakistan as high as 22%, which was the case until a few months back. And it is only the start of monetary easing. So that, of course, will play a huge part in driving the next leg of re-rating for the market. And when I say re-rating, it's important to look at things in an apples to apples manner. So yes, the stock market, the index is itself at 80,000 points. The previous high in 2017 was 53,000 points. So obviously, if you compare to that, it seems as if the market has really gone much above the previous high. But you have to look at things in the context of the underlying profitability of the listed companies. And on average, our companies trade at 4 times their profitability. And the last 10-year average is between 7 and 8 times. So if you anchor yourself against where we've been in the past, not even the peak, just the average of the last 10 years, you can see that we're still at a roughly 50% discount to the historical mean valuations. Secondly, I also mentioned that as interest rates come down, more and more money will be drawn towards the stock market. And just to put some numbers here for context, The mutual fund industry in Pakistan, roughly 10 to 12% of their money is in equities. Roughly 90% of that money is still in the fixed income instruments. This number back in 2017 was tilted towards equities. More than 50% of the money available with mutual funds was invested in the stock market back in 2017. Merely 10 to 12% of that money right now is invested in equities. It's a very similar tale when you look at the local insurance companies. They're also underinvested relative to their investment in equities in the past. And a very similar picture for foreign investors as well. Their ownership right now is dwindled down to just 4.5%, of the ownership of the market capitalization versus a peak of 10% in 2017. So really on those metrics as well, you can see how much underinvested we still are. And with the economic stabilization underway, with the exchange rate also appearing to be at least not of concern right now, you can expect that the monetary easing that we expect will pick pace in the second half of the year will drive that re-rating. So I would certainly expect the market to continue doing well, as has been the case in the recent past. I mean, the index, as I mentioned, has nearly doubled over the last 12 months or so. And our price to earnings multiple, which is the multiple at which our companies trade at relative to their profitability, is still 4 times. Even if we see interest rates come down to the mid-teens, say the 15% mark, historically at that time, the price to earnings used to be between 5 to 6 times. So even if you go to 5 times from 4 times, which is the case right now, that's another 25% increase. And there are several brokerage firms out there that are predicting the index to cross the 100,000 points mark this year. And simply that is simply going to be driven by valuation re-rating. You simply have to go from 4 times earnings to 5 times earnings, and that's that will take you towards that 100,000 mark. So that sort of return is still very much on the cards, in my view, in the next 6 months. Now, of course, there are risk factors. It is still a fragile economic recovery. Our import cover is still low. We desperately need to sign a new IMF program in a timely manner. So, of course, if these things don't happen, if we're unable to preserve this hard-fought and hard-won macroeconomic stability, then a lot of these gains will prove to be very fleeting. But as of right now, if you look at what the finance ministry is guiding for, it seems as if they're quite confident that the IMF program will be able to be secured. And if that is the case, and macroeconomic stability is preserved, then the base case of interest rates coming down and driving valuation re-rating at the stock market very much remains in play.